Google just reported earnings and the stock dropped 10%, taking the company's valuation down to $1.58 trillion. But this was a perfectly fine earnings update from Google. In fact, quarterly revenue hit a new record of $77 billion, which was 11% higher than the year before. Net income was also up by 7% on the previous quarter, and the company generated almost $23 billion of free cash flow. There was also strong growth in YouTube ads, up 12%, and Google Cloud, up 22%. That means Google has now reported almost $300 billion in revenue over the last 12 months, $67 billion of net income, and $93 billion of EBITDA. And that means the stock is currently valued at 5 times revenue, 24 times earnings, and 16 times EBITDA. But if this report is so good and Google is hitting record revenues, why is the stock down 10%? One reason is that the company is experiencing slowing growth. Although total revenues grew by 11%, that's lower than Google's 10-year revenue growth rate, which is closer to 18%. And although earnings increased in the latest quarter, they are still slightly below the peak that was set in 2021. And although Google Cloud was up 22%, Microsoft's cloud product Azure grew sales by 31%. Longer term, Google is still heavily dependent on its search product, which makes up 57% of total revenue. So, if competition or developments in artificial intelligence make a dent in Google's search, that would be a huge issue for Google investors. Right now, however, there's no evidence of a slowdown because Google's search revenue increased by 11%. Meanwhile, Google has a lot of other projects that are moving in the right direction, from YouTube subscriptions to the new Pixel smartphone and AI. Over the last 10 years, Google has grown its earnings at an average rate of 18% per year. But let's assume a more conservative rate of 12% going forward. In that scenario, the company would be producing $118 billion of net income in 5 years' time, and a 25 times multiple would put the valuation at just under $3 trillion. That works out to an investment return of 13% per year. So maybe Google doesn't achieve the same growth rates of its past, but the company also has $120 billion of cash. That will help improve earnings per share by funding stock buybacks, and it also helps to fund exciting new projects like Waymo. Fundamentally, Google still looks like a solid investment, which is why I continue to give the stock a bullish rating. But these are my personal opinions, not financial advice, and I do own a position in the stock. If you want to see more videos like this, please check out my new website, 3minutebreakdowns.com.